When we're creating financial plans for clients, one of the common objectives is to pass assets as tax efficiently as possible onto the next generation. And one of the common strategies we use is something called a next gen Roth conversion, and it allows individuals not just to pass assets onto the next generation, but to pass them on tax-free. And there's also ancillary benefits associated with these next gen Roth conversions, which includes potentially shrinking the size of someone's estate if they're worried that they might have to pay estate tax. It can reduce their future RMDs for themselves because we're shifting assets from a pre-tax account to a Roth account, and also it can help the beneficiaries navigate the new 10-year rule associated with non-spouse beneficiaries. At a high level, here's how the strategy works. So we're looking at retirees that have sizable pre-tax retirement account balances, traditional IRAs, SEP IRAs, 401k plans, and we're trying to take advantage of their low to medium tax bracket because they don't have a paycheck anymore. And when you do these Roth conversions, it is a taxable event where you're shifting money from a traditional IRA to a Roth IRA. So if I moved $100,000 from one to the other, that creates a $100,000 taxable event. But if I look through to the beneficiaries of my IRA and say, well, my kids, for example, are in the same tax bracket of me, or potentially higher because they're still working, if they were to inherit my pre-tax retirement account, they're going to pay even a higher rate than I would, which is why it makes sense to do these Roth IRA conversions, saying I'll get it taxed at my rate as opposed to the kids paying tax at my rate or higher. This strategy has become widely more popular because, as I mentioned before, the new Secure Act 10-year rule for non-spouse beneficiaries, which means if you inherit a pre-tax retirement account, the year after that person passes away, you have to fully deplete and pay tax on that account within a 10-year period. And if it's a sizable pre-tax IRA balance, let's say you get $1 million pre-tax IRA balance, if you're still working or you own a company as a beneficiary and you're already making $300,000 a year, and you have to realize all the taxation on that $1 million plus the growth within a 10-year window, that can make that pre-tax distribution subject to extremely high tax rates. Let me show you how this would work in an example. So let's say we have Josh who inherits a $600,000 traditional IRA from his father when he is age 50. So Josh is a non-spouse beneficiary, would be required to pay tax on that full $600,000 within 10 years of his father passing. But what if Josh was married? And what if Josh and his wife still work, making $360,000 per year in income? If Josh and his wife do not plan to retire within the next 10 years, that's $600,000 in the traditional IRA that is required to be distributed would be subject to very high tax rates because the taxable distribution stacks on top of their existing $360,000 that they're already making in income. A large portion of those IRA distributions could be subject to a 32% Fed tax bracket. If instead Josh's father began processing Roth conversions in the amount of $100,000 per year while both his father and mother were alive, in 2025, the 22% federal tax bracket is between $96,000 and $206,000 in taxable income. So if Josh's parents had very little income in retirement, they could process these large Roth conversions, pay 22% in Fed tax on those Roth conversions amount, then pass on a Roth IRA to Josh instead of a traditional IRA. By utilizing this strategy, the full $600,000 pre-tax IRA was subject to the parents' Fed tax rate of 22%, as opposed to Josh's tax rate of 32%, saving approximately $60,000 in taxes paid to the IRS. But it gets better. Not only is there multi-generational taxes saved by the parents realizing the income at their lower tax rate versus their children's higher tax rate, but also when, let's say, Josh inherits that Roth IRA, he gets to accumulate that account another 10 years, potentially double it again, and then when he pulls it out in year 10, he pays no tax in any of that account balance. This is where we get into not just wealth transfer, but tax-free wealth transfer to the next generation with the ability to accumulate another 10 years tax-free after the decedent has passed away. Now, when you inherit a Roth IRA, similar to a traditional IRA, you are still subject to that new 10-year rule unless an exception applies to you. So that means you do have to distribute that account in 10 years, but all the accumulation within that 10 years is tax-free. Now, in accordance with the Secure Act, whether you inherit a traditional IRA or a Roth IRA, you're still required to deplete that account within 10 years, but the added benefit of inheriting a Roth IRA versus a traditional IRA is a traditional IRA, not only do you have to deplete it in 10 years and pay tax on all of it, but with a traditional IRA, depending on what the age of the decedent was when they passed away, you might also be required to take an RMD, or required minimum distribution, each year during that 10-year period where Roth IRAs do not have that requirement. I want to show you how powerful this is in an example. So let's say Sue inherits a $500,000 Roth IRA. She takes out no money for the first 9 years, and at the end of the 10th year, fully distributes the tax-free balance. If Sue invested that account wisely and obtained an 8% annualized rate of return, at the end of year 10, there is $1,079,462 sitting in that account that can be withdrawn completely tax-free. The second big benefit associated with this next-gen Roth conversion strategy is potentially shrinking the size of someone's estate. So if someone has an estate that's large enough that could be subject to tax at either the federal level and or the state level, they're usually trying to find ways to shrink their estate. Well, one of the benefits of these Roth conversions are you're generating tax liability, which you're paying to either the fed or the state, which is essentially reducing the size of your estate. If, for example, someone has a $15 million estate and included in that estate is a $5 million balance in a traditional IRA, if that person does nothing, it creates two problems. First, the balance in the traditional IRA will continue to grow, which will increase the estate tax liability that we do when the individual passes assets on to the next generation. And second, if there are only two beneficiaries of the estate, each beneficiary will have to move $2.5 million into their own inherited IRA and fully deplete and pay tax on that $2.5 million plus earnings within that 10-year period, which isn't great. If instead that individual begins processing Roth conversions of $500,000 each year, and over the course of 10 years can fully convert the traditional IRA to a Roth IRA, two good things can happen. First, if that individual pays an effective tax rate of 30% of the conversions, it will decrease the size of estate by about $1.5 million, which is the $5 million balance in the traditional IRA times 30%. With potentially lowering the estate tax liability when assets are passed on to beneficiaries of the estate. Secondly, even though the beneficiaries of the estate would inherit $3.5 million in a Roth IRA versus $5 million in a traditional IRA, no RMDs would be required each year, and the beneficiaries could invest the inherited Roth IRA, potentially double the value of the inherited Roth IRA during that 10-year period, and withdraw the full balance at the end of the 10-year completely tax-free, resulting in big multi-generational tax-free wealth. While I've been focusing more on the benefit of the compounding that happens after the decedent has passed away in that 10-year period, the compounding tax-free benefits begin from the day those Roth conversions are processed by that original account owner. In an example, if Jim processes a $200,000 Roth conversion when he turns age 70 and lives until age 90 and achieves an 8% rate of return during that 20-year period, when Jim passes away at age 90, the balance in that Roth IRA would be $932,191. The non-spouse beneficiary then inherits the Roth IRA and invests that account, also achieving an 8% annual rate of return, and in year 10, the inherited Roth IRA would have a balance of $2,012,531. So the original owner, Jim, of the traditional IRA paid tax on the $200,000 Roth conversion, but it created a $2 million tax-free asset for the beneficiary of that Roth IRA. The third tax benefit that this next-gen Roth conversion strategy creates is it actually reduces the future RMDs for the existing account owner. So if someone starts processing large Roth conversions at 70, by the time they hit RMD age at, let's say, 73, 75, it is effectively reducing those future RMDs and reducing the tax liability because we're shifting money from the pre-tax IRAs over the Roth IRAs, and the Roth IRAs do not have an RMD requirement. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.